eating into that bond universe of long-term capital preservation. And so at that point, that's when it reaches $1 million. And I think that we're going to hit that at some point in this next.
So I've been looking forward to this.
Yeah, of course. It's great to be here, Luke, and I appreciate you having me on.
Yeah, thanks. Well, it was an honor to meet you in Miami. We met in Miami at the Bitcoin conference, hung out a little while at uh, one or two parties.
Yeah.
And yeah, that was great. I've loved your work. I've loved your work for a long time, and you have quite the impressive track record. You have amazing content out there. If I correct me if I'm wrong, but let's see, you went to Cornell and Yale, right? And then you
Yeah.
were an arbitrage trader, a portfolio manager, and a reformed hedge fund manager, whatever that means. And now you're
Yeah.
into Bitcoin. So you've quite the education, you've quite the traditional finance experience. So I'm looking forward to hearing about all that, and then how
Absolutely.
that what that reformation is into Bitcoin and what that means. So
Well, if
uh,
you've been on Wall Street for 30 years, you're either so deep in you don't even see it, or you see it and you want out. So,
yeah.
but no, I mean it's look, I've been in traditional finance, institutional investing for nearly 30 years, and the world has changed quite a bit since I started there. And yeah, like you said, I actually started on the floor of the New York Stock Exchange. I was a clerk, and I was trading what's called ADR arbitrage, where you're trading foreign securities on the New York Stock Exchange. So we had customers here in the United States who wanted to buy international shares, and we had customers overseas who wanted to buy U.S. shares. So we would change them for them, and create what's called an ADR, which is just an American depository receipt. And there was you know right off the bat, I was dealing with math and currency and exchanges and baskets and stamp taxes, and so it was a little bit of a baptism by fire. But that because I worked for a British investment bank and was doing that kind of put me in this place where I could go just right into a hedge fund and do the same sort of thing with different instruments. So I went into something called merger arbitrage and convert arbitrage, and so yeah, so it's been a wild ride. Not what I expected to do when I was a kid. Nobody expects to be on the floor of the New York Stock Exchange, I don't think, unless you're from a family that's been on there. But my dad was a nuclear engineer, by study and training, and so we were not a finance family whatsoever. I mean, I was expected to do something professionally when I left Yale, and so my options were kind of doctor, lawyer, or engineer. And being a little bit of a rebel, I went into finance. So
And now even more as a rebel, you've gone against the finance world in the Bitcoin land. So
just don't let them pin you down, Luke.
yeah, yeah, that's that's fascinating. So your dad was, what'd you say, nuclear engineer, correct?
He was, yeah. He worked for Navy Nuclear for many years, for basically his entire career. What he did was he designed nuclear reactors that went into the steam turbines that went into the submarines. So that's what his focus was. So
Hmm.
basically his client was the Navy. So, or
Yeah,
not his, but his groups,
yeah. That,
section. So
that's really interesting. I think a lot about who are the people that are drawn to Bitcoin. For me, I look at my own life and I can just see in retrospect, it's obvious, kind of like how you went to Yale and you didn't know where you're going, but now here you are.
yeah,
For me, I feel like a similar thing in that I made movies and I loved history. I loved learning about currencies. I loved learning about cause and effects and thinking about how one technology will do other things and timelines and anyway, like looking back, it's like, oh, okay. So I have experience in storytelling and I have experience in learning about history. And I loved physics too. I loved black holes. And so it's like, merging those worlds together of storytelling and engineering slash physics and
yeah,
history. That's how I came into Bitcoin. And it's funny hearing your story, or that's in retrospect, that makes sense how my personality is oriented to that. And so it's fascinating to hear that
sure.
you have that multi-decade experience of currencies and arbitrage and managing risk, and also your family, your dad, your family have that engineering background. Do you think about that at all, about how the
Oh
past
yeah.
experiences have led you to this moment?
Absolutely. My dad would have loved Bitcoin. He would have been fascinated, obsessed with it. He died before I got into it, and he didn't discover it himself. Like I said, my family wasn't too into finance, but yeah, it's absolutely fascinating. And I feel like you have multiple lives. My wife and I talk about this all the time. You're a kid, you go into college thinking you're going to do something, or go into your first kind of work thinking you're going to do something and be there for a long time, and then you wake up and things change, and then maybe you get married, maybe family, you move to a different part of the nation or the world, and then you have a whole new, it's a whole new life, and then your kids kind of get older, and then it's another life, and then they're gone, they're out of the nest, so then so you've got a lot of different paths you can take at each of these kind of growth phases. And the idea is to keep yourself challenged and to keep learning. And for me, I've got all that experience. And so coming into this world, I realized, wow, people really don't understand what's going on in institutional finance. And most people don't even understand really what's going on in finance. And it's not their fault. It's just not something that's taught. And so that's kind of how I came into this world. I found Bitcoin. I realized how important it is to help change the world. It could help fix so many problems that we have in our financial world, driven by central bank, policy and greed. But we could change a lot of that, and helping people who aren't in this world just understand money. And if you understand money, you understand investing, and why you have to invest, and why you have to beat inflation, and what inflation really is, and why it comes about, and how all these different parties are kind of they're contributing to the problems. Then you can get to, oh, I see the solution. And that's that's kind of been my mission for the last couple of years. And so and it's been fun meeting people like you.
Well, thank you.
So
Likewise, meet people like you. So, so how did you get on the mission? Because if kind of elaborating what you're just saying, they're like concentric circles. So you have the circle of everyone, and perhaps people that don't care about finance. Within that, people that care about finance, and people within that understand there is a problem. People understand what the problem is, and within that, people that understand the solution. And so you are already very close to the middle of that target, and that you are a hedge fund manager. So how did you make that bridge? What was the aha moment? Was it the engineering background? Was it understanding the debt spiral, as you've become famous for
yeah.
online? What was the aha moment or the vantage point that made Bitcoin click?
A lot of things clicked, and it was just I felt, first of all, just intrigued with it, and I just kept studying and studying and reading and listening to podcasts and watching different podcasts, and watching Michael Saylor talk, and I got a lot of it, and I was like, this, so much of it makes sense. And just what really tipped me over the edge, and I've said this before, is I was listening to a podcast of Jeff Booth, and I didn't know who he was at the time. And so I'm supposed to be, and I've told the story a little bit before, but I'll shorten it here. But I was supposed to be helping cook dinner with my wife, and she's like, well, what are you doing? I was like, hold on, I'm watching this podcast. I just can't stop watching, because Jeff is explaining why Bitcoin is necessary, with the natural evolution of technology, and why that's deflationary, or it should be, and the Fed and central bank are actually working against that. They need inflation. And I was like, hold on a second. So I told her, well, come here, you gotta come see this. And so I had my laptop, we're sitting on the edge of the bed, and we watched the whole thing. And at the end of it, she was like, do we own enough? So, and I was like, what it was really was, it struck home to me that the issue of expanding the money supply to fight this mountain of debt, you know, and having to do that while you've got these technologies that they're supposed to be deflationary, right? So everything is getting more expensive. You've got thousands of millions of songs at your fingertips for just like $9.99 a month or whatever. And you've got movies that you can download onto your TV rather than buying a CD, or you could just rent them, or the photos, you can take photos, endless streams of photos with your phone, which are pretty good cameras, and store them. You don't have to buy the film, buy the camera, buy the film, have the film developed, have all this paper, have something to store it in, but you've just got it. It's all right there. And so that's deflation, right? So you've got an expansion of use cases from this technology that you're paying less and less for every single year. Storage is so cheap now, So, and then I realized that that's what's, that's the fight that's the fight that's going on behind the scenes. And then Bitcoin is the elegant solution to solve that. And so, it just clicked for me. I was like, okay, now I get it. Now I'm going to try to help people understand this whole money problem. And, and then I started I wasn't anybody on Twitter. I basically hadn't used my Twitter at all. My wife is an author, and I had a bunch of author friends on there, and, she followed me, and a bunch of her friends followed me just because I would put out stuff when her publisher released things. And so, but I didn't really use it for anything. And then I got on there and started following some people and listening and joining in the conversation. And next thing you know, I realized, well, people actually want to hear about the stuff I've done. I didn't realize there weren't that many people who have done what I've done that are not on Twitter, and certainly not in this world. There's just a handful of us. And so it's been great to be able to share my experiences and my knowledge, and really what the insight to the behind the scenes of what goes on with these big banks and how they actually interact with each other. And so, and that's been enjoyable for me, and that's how my newsletter started. The information is that it literally started with me explaining a few things. So yeah, that was a long answer.
No, it's great. I'm in a very similar boat that I had a Twitter account. I wasn't really using it, and literally same day posted my first thread, it blew up, and now here I am. I'm talking to you, and so awesome. I had a very similar experience there, and I often wonder, like, if we're right about this Bitcoin thing, people like you and me and others, we have an important role, kind of like how you're saying how we multiple lives. It's like we also like multiple missions to a certain degree. It's like right now this is our mission, and if we're right about this, we'll be offering a greater and greater valued service to the world as the demand for your brain and your experiences and your insights goes up. And I love the booth and the metaphor and the explanation you gave there of the two conflicting sources, that basically we have human innovation and ingenuity trying to force prices down as we make more stuff for people with more prosperity. But then we also have that monopolization and centralization of money. We have that political force fighting it. And I think something that is perhaps your unique presentation on the Bitcoin perspective is being in that world, being in the hedge fund finance world. You very articulately can describe the insustainability of that political currency system and the debt spiral.
And it's and that's what it is. It's just and for most people, they think, oh, Bitcoin an investment, and I mean, it's gonna itself have different phases in its life, and it's gonna be super speculative. It's gonna go from 10 cents to $1, from $1 to $100 to $10,000, and that's what happens. And some people get super rich from that. And then it kind of stabilizes. We're in this period where it's trying to find stability. There's a lot of attention around it. There's a lot of uncertainty still with legislation and all that, and taxes, and especially from country to country. But as that kind of gets itself ironed out, and more institutional money comes in, and really institutional money, there's a lot of confusion around that too, right? So people hear BlackRock, or they hear Fidelity, or they don't want the big guys coming in and ruining it. And reality is, look, Fidelity just manages millions of accounts for other people. BlackRock just manages millions, trillions of dollars for a lot of large accounts. And so it's necessary to have that capital there. Why? Because at some point, when there's enough money in the ecosystem, it completely stabilizes and becomes a separate asset class. And then you can truly build out that the lightning and second and third layer protocols that will reach the entire world at the depth and the economy of scale that you need for it to be. So it's good. It's taking a while. It's going to take a while, but I believe that we're just on that path. And and like you said, the debt spiral is almost, it just makes it almost a certainty that this is the without a doubt, it's the best solution we have on the table right now. So to help fix some of those things.
Yeah, certainty is a strong word, especially investing. That really gets people to think.
Mm-hmm.
I saw a chart of yours recently, or I don't know if it's your graphic or graphic you found, but the Treasury put out a report. I don't remember when this was, but they put out this chart here. Hopefully, you can see my
Yeah,
screen.
this is last January or February they put this out. Yep.
Yeah, and so
That's the red line is my line. And
yes, yeah,
yeah, so what this is, it's a chart. The Treasury puts out they put out a report periodically that's about just the state. It's kind of the state of the union of the Treasury, and this report was the state of the Treasury, and the subtitle of the report was an unsustainable fiscal path, and it showed that black line that is just it's rising from the upwards from the left to the right, and that's the amount of debt we have as a percentage of GDP. So where we are right now is down at the 120% level on federal debt and 130 plus on all debt and in the government. And so but the issue here is that black line, it is an exponential curve because you're showing percentage rise on the left. It's not absolute, but that assumes a constant rate of change. And I believe that we're going to have an even worse, rate of change in the future here. And so even the exponential line needs to be curved. So, but that's the problem, is that we have so much debt on our books. We're seeing it right now. I mean, we're literally witnessing it today. Now, I'm not saying that this is that point in time where the world implodes, the dollar hyperinflates, and it's all over from here. It's just that you're seeing these things happen where the Treasury has so much debt. Now all right, well, there's a lot to unpack here. So first of all, debt in and of itself is actually not that bad of a thing if you use it wisely and you use it responsibly. All it's doing is pulling future productivity into the now. You're borrowing money to start whatever business or create whatever productivity you want to create now. Whether it's if you want to open a car wash, you're going to have to borrow money or have a lot of money, millions of dollars, to get the machines, set it all up, get customers, get them through, hire workers, start paying wages, and then you can start generating income and revenue and income. But if you don't have that money, you can borrow it and pull that into the now. It's a simple concept, but the problem is we are not being terribly responsible with the way we borrow, right? So, and what we're seeing today is that just there's a chart put out by the St. Louis Fed. It's called we call it the Fred charts. And they have a chart that shows that the interest expense this year annualized is expected to be $970 billion. That's just the interest on our debt. That's a line item on the Treasury's balance sheet, right? So on their income statement, whatever you want to call it, their budget. So that's the issue, is that we're paying so much interest on the debt. Okay. We have to borrow so much money because we're running such high deficits that it's just ballooning, right? So that's why that number is going up and to the right, because this year, the Treasury this year had just put out a report last week that said they expect to borrow, wait for it, $1.85 trillion in the second half of 2023. That's just in the second half. So that's how much debt they're going to put on the books for the second half. That's after borrowing 1.3 in the first half. So we're looking at an extra $3 trillion of debt this year. And that's how that debt to GDP number just keeps exploding. And as we continue on with these high interest rates, every single month that we have high interest rates, you have treasuries that mature. And since we operate in a deficit, we don't have money in the Treasury general account to pay that down. So, when a bond matures, you get your principal back, right? So if it's $1,000 bond, you're going to get all that interest you had all the way up to that point. Plus, then it matures, you get your $1,000 back. Well, the Treasury doesn't have it. So they've got to issue more bonds to borrow from the future to pay for the past debt. And so they're just continually doing this. And this is called the debt spiral. And with interest rates going higher, that interest expense gets larger, the deficit gets larger, and they just have to borrow more. That's it right there. Exactly.
Yeah. Yeah. So just to help give people a visual aid here, here's the interest expense that you're referring to. This is not the other things you mentioned. This is just the interest expense of the federal government here. And so you can see how in this part here I'm highlighting on the right, you have the post-COVID era. This is the period where I realized in 2020 or so, I realized that we had a lot of red flags. Whoops, we zoomed in a bit here. But no matter what point you go, what era you go, the interest expense is always increasing. So it's most recently, this is the 90s and 2000s. This is back in the 60s to 80s. And then even back in the 50s to 60s. So James, this has been rising, but it seems like the rate at which it's rising is
well, it sure does look it, doesn't it?
No, yeah, it looks like it's been rising, but because it's exponential, the previous iterations don't show up, but it looks like the rate is skyrocketing. And then, like you said, it's the problem is that we're at historically low interest rates. After 40 years of lowering interest rates since the 70s, it's like we are leaving the parabolic exponential curve we were already on into historically low interest rates. And so
so if you weren't alive in the 80s and all you've pretty much known is ZIRP, which is zero interest rate policy for the last 13 years, since the great financial crisis, we've been living in this. We had rates starting to tick up before COVID, but they went straight back down to zero. And we've been living in this in super low interest rate environment for so long that now with rates going up, the Treasury's borrowing, they're paying down the debt that's maturing at just somewhere between 0.25% and just 1 or 2%. And now they're having to issue debt that they're borrowing at 4.5%, 5.5%, 6.5%, 5.5%. So that's the issue, is that they're having to borrow at multiples of what they were before. So that's why that interest payment, and you have somewhere between 35 and 40% of debt is going to mature in the next 2 years. And so it just keeps happening. So go back to spring, we had the whole the whole debt ceiling issue. Well, the Treasury general account was drawn all the way down to just like $30 billion, which we could spend before a morning coffee, And so there was basically nothing left. And when the debt ceiling got lifted, which all it did is it just kind of got put on pause, right? So when that happened, the Treasury had to go and fill its accounts back up. So it immediately started issuing a ton of debt. But the issue here is that it didn't want to send a tsunami of debt to the market, because who's going to buy all that debt, right? You've got Russia, China, and Japan uh, China and Japan, the two largest buyers of our debt, were already backing off it. Japan was selling our debt just to shore up their own currency. China has been backing off our debt. So what does that mean? Well, they didn't want to just flood the market with treasuries because they needed a place for it to be soaked up. So they had to start issuing short-term treasuries, right? So they're issuing paper that's just 1 month, 3 months, 6 months, 1 year maturities, because they needed to fill up the coffers fast because they had all this debt that was maturing. They needed to pay down some bills. They borrowed internally, they had to pay. They needed about $1 trillion, Luke, in June. So they issued all of that debt, but they issued it short term. That's why they have to keep issuing more debt, because it's now it's starting to mature already. Just 1 month later, it's already starting to mature. And so they have to issue again. Why did they do that? Because there's this great big reservoir of capital sitting in what's called the reverse repo facility. And that's sitting there because that's capital these banks are sitting on that they can't use to buy treasuries because of certain rules that they're having to operate under that prevent them from holding too many long-term treasuries on their balance sheets, on their books. So they can buy the short-term treasuries, but they can't buy the long-term ones. So they're using that reverse repo. You've seen the reverse repo get drained down by just about the same amount of that delta between the maturing debt that gets reinvested into new debt and the new debt that they had that's where the reverse repo has been drawn down to make up that difference. And that's what's been going on, right?
Here's that visual of the reverse repo market that you're mentioning here. And I
So
think
it's up at like
yeah.
2.35 trillion
Mhm.
just about a month and a half ago, and now it's down, in the 1.7 range.
Yeah. And for context here, let's see if this will zoom out. So this is back 2015 or so. This is what the reverse repo market was looking like. Let's zoom a little bit over to the right, go into the future a little bit, and there we see COVID over here. That gray
Yep.
vertical column. That's the COVID
Yep.
reverse repo spike. And then let's go over to a little more recently, back to where we just were, and that's where we are today. So the visual here is just striking. It is so much more than it was in the 2010s. It is so much more than it was in COVID, and now it looks like we're trying to scale back off that a little more. So
Right. And so what are they? So they're talking about changing rules and allowing banks and forcing banks to hold more treasuries,
yeah.
and that will drain that account more. And so they're looking for ways to use that capital because it's just sitting there, right? So, there are arguments to be made that inflationary, deflationary, you can, that because it's capital, it's sitting that reservoir that banks can use to lend off of, or that just comes into it. Really, what happens is it's coming into the economy, right? Because the Fed is issuing all this debt and then turning around operating at a deficit, and they continue to operate and just enabling the treasury, to operate at a deficit. And as Luke Groman has been talking about, that's inflationary. And it is. So it's a wild, like, Luke, I've seen a lot of stuff in my career, in 30 years between the Russian ruble crisis, long-term capital management implosion, the tech bubble of 2001, the Enron WorldCom frauds. Then you've got the great financial crisis. Then you have COVID. This is just this is a really difficult market to be in, a very difficult market to be in. And so I'm not a huge risk taker. So I have not pushed all my chips into an NVIDIA position, for instance. That's just not the way I'm built. I've managed risk for many of my years in my career. And so what I try to do is survey the landscape, try to figure out where the landmines are and avoid those best I can, while retaining my capital and allowing it to grow in a sensible way. And it's been a bear of a market to do that, truly. So, yeah.
I think I hear what you're saying is that you've been in risk management for a few decades and you're a very risk averse person, and yet you're very much into Bitcoin. See,
Mhm.
most people that doesn't really line up, but
Yeah, it's
it
interesting,
makes
right? Well,
perfect
that's
sense.
yeah, and it ends up, you've heard Greg Foss talk about this quite a bit. He talks about being a natural CDS, um, contract for difference, CFD, sorry, for a basket of sovereign debt. And that's a good way to put it, And so if you have a number of sovereigns that collapse, look, we are extremely fortunate to be sitting here in the United States with and using every single day and saving every single day in the global reserve currency. Like, we are fortunate. And so when people talk about Bitcoin here, it seems like this shiny little diamond. It's like, can I get rich off of it? Like, there are people who are living in Ghana and Lebanon and Venezuela and Argentina that need this to protect their capital. Why? Because there's so much inflation out there. I mean, rampant inflation where you have 80% inflation per year that's being reported in places like Venezuela, like, that's problematic. So those people, they need something where they can actually hold their stored value that they've created in something that's not going to just evaporate. Number one. Number two, it's kind of a hedge against that hyperinflation of their own currency. And it's better than gold for them because they can access it anywhere, anytime, and they can take it with them if they just memorize their key phrase. They don't need to be worried about being stopped at the border and taking their wealth someplace that's not oppressive anymore, at least not financially oppressive. And so that's it. That's where it's kind of that's the mission, right? To get this into a billion people's wallets for them to understand why it's so important. That's the mission. And so, using it in my portfolio, it's a completely different purpose than someone using it in a portfolio who's in Venezuela, for instance. That's a completely different use case at this point. You know,
Yeah, it reminds me of what you said earlier. It's such a good point about how just like you, just like me, Bitcoin will have its own life. It'll have its own lives. It has its first, it's tradable, speculative speculation era. Then it has its store of value era. Then eventually, in the far future, it'll have its media of exchange unit of account eras. Kind of
exactly,
like we
exactly,
go through
exactly.
college, marriage, kids.
And
Like
again,
the same
gold did
thing.
the same. Gold did the same thing, right? So,
Yep.
and that's what it
Yeah.
is. And so, yeah, and it's kind of funny because it'll operate in a different timeline, different places, a little bit,
Yeah.
and because it is more of a store of value for someone in a hyperinflating currency or super inflation
Yeah.
environment right now than their own currency. And
Yeah.
so it's important, even though it's volatile. Although it's been a stable coin for the last few weeks, right?
Yeah. Yeah. At the time of recording, it's historically it's very rarely been this lack of volatility has been very rare. So, probably by the time this comes out, Bitcoin will be higher, but we'll see. Yeah, what you just said reminds me of Lebanon. The Lebanese pound Bitcoin is officially at like 400 million in terms of Lebanon's political currency units, and
So
unofficially it's more like 4 billion, so like 10
it's
times that.
awesome.
So
Yeah, and I
yeah,
wrote a whole article about hyperinflation in my newsletter, and it's startling. It was actually when I sat down to write that, and I was doing some research on the different currencies that hyperinflated. It was nauseating to just think about. Oh my God, if you're sitting there and you have nowhere to go, like if you don't own anything and your assets are like you're in such deep trouble financially. It just completely destroys people, and it's a tough environment. So
yeah.
yeah,
I'm glad you brought this up. I think as Americans or Europeans or Canadians, we often forget that, and we think like, oh well, America will suffer, and the rest of the world will. And like I think that's important to emphasize that America is the least bad fiat of all the other fiats. And again, I
yeah,
think that's worthy going back to that chart that you annotate here, and again emphasizing that this black line is the Treasury's prediction
yeah,
of debt held by the public. And both you and I, James, know that it cannot be linear. Number one, because interest is never linear. Number
Yeah.
two, because borrowing from the future via debt, so the principal itself is never linear. Number three, because interest payments they have to go up since we are coming out of historically low interest rate periods. And number four, like you were saying before, with the technology versus central banking conflict, technology itself is
Yeah.
exponential. And so, like, that's right there, that's four or five massive forces that are
Yeah.
forcing this chart to be exponential. Then you add
Yeah.
on
And
that, yeah,
yeah. And the, well, and you know, the answer to it, which is something that I wrote about just a couple of days ago, the answer really is just uh, perpetual, you know, sustained inflation at a higher rate than the 2% that they'll ever admit to, and the perpetual inflation will help pay down that debt. So you can expect more like 4 or 5%, you know, inflation going forward for a while, and there could be periods where it spikes up way above that, you know, but the just understanding that investments and owning hard assets are going to be important going forward because
yeah,
everything is going to inflate. That's the only way that the treasury can pay down this debt without having to do something that's extremely painful, which is either cut Social Security or entitlements, you know, which that's not going to happen. Raise taxes, which in the end only ends up lowering productivity. It takes away incentives, and companies can't reinvest it like they would, and the productivity comes down. So that's not a really a viable option long term. And the other option is to just not pay the debt,
default.
default. But if you're printing your own money, or if you're, let me back up. If you're issuing debt in your own currency, you can print money to monetize that debt. We're seeing that happen in Japan right now. And
Yeah.
so the only other option is to allow for perpetual sustained rates of inflation.
Thank you so much for watching my content and being a supporter of mine. I really appreciate it. It's a lot of fun for me to do, and it's really meaningful to know that so many people are enjoying my content and learning about Bitcoin. I think it's so important for people to get off zero. In addition to getting off zero, it is really critical. It is really important that you also begin taking self-custody of your sats and of your Bitcoin. This is because if you have Bitcoin on an exchange or you don't have proper self-custody, this is going to be a massive problem for you in the future, most likely. If Bitcoin starts having rapid periods of appreciation and there are rapid spikes in demand for Bitcoin education, and for Bitcoin advocates and advisors, it's going to be increasingly important that you have self-custody of those coins. So my message to you is please consider getting that self-custody. Now, you can do that on your own. There are plenty of free tutorials online. There's plenty of great work like that. But if you want somebody to help you with self-custody, if you want somebody to help you take cold storage of your Bitcoin, of your Satoshis, if you want somebody to help you set up a multi-sig vault, to set up an estate plan, to set up a plan for you as a person, an individual, as a business owner, as a charity, whatever the case, I work at the Bitcoin Advisor, and I'm happy to say that I really enjoy it. I love working with my clients. You know, my job is literally to help people buy Bitcoin and secure it properly for years, decades, and generations to come. So if you want to learn about my services at the Bitcoin Advisor and what we do, you should click the link in the description. Here you can read a bit about what I do. You can book a free consultation with me. You can book a free meeting with me. I'll send you lots of free complimentary paperwork explaining how multi-sig vaults work, cold storage, giving you all the education you need. Everything's fully open source. What we do, our main goal is education, helping get coins off exchanges, and people be able to not lose sleep at night when they buy and secure their Bitcoin. So you can feel free to book a meeting with me. The first one is free and complimentary, just to figure out what your priorities are and get that adjusted. But if that's something that could be used to you, I really highly encourage you to take self-custody, whether that's with me or not. Please just do it. But for the many of you that probably will eventually want a multi-sig collaborative custody vault, the Bitcoin Advisor could be the place to go. And so click the link in the description, check that out. Really appreciate your time.
Okay, James. So here is the tweet of what you're speaking about. So you say here that there are three ways the U.S. can lower its debt, and I would assume you're implying all nation states can lower the debt. Number one is austerity, which is lowering spending, which is political suicide. Number two being to raise taxes, and number three to allow for structural inflation. Now, I don't know how you'd feel, but I would always add a fourth one, and that would be war. So, I think that's always the fourth option too, unfortunately. But yeah, it's great to read this because this is exactly in my mind the well, plus that one additional one. The only options I can think of is either reduce the spending, raise the taxes, or debase the currency that you're denominating the debt in. So if you could break
Right.
down what you're commenting on here, obviously we have your tweet, but you're commenting on Lisa here. What is she talking about here? What's this chart we're looking at?
Yeah, so she's talking about how this whole treasury sell-off was it's talking about how people are expecting higher for longer, meaning higher rates for longer. And so, but there's a lot of stuff that's going on here, right? Because right after this, you've got the S&P had already downgraded US debt, and then Fitch just jumped on board and downgraded US debt. And so the long dated treasuries, the interest rate has spiked. And so part of that is because people realize that, okay, Fitch has done enough homework to understand and also believe that we're going to have higher perpetual inflation for a long time. And that's really the only way to do this. And so, one of their jobs is to caution people against the possibility of default. And when people read those readings, they think, well, AAA, that means there's almost zero probability of a default, right? But you can also have a technical default, which we've had before in 1979, where we pushed it right up against the edge and Congress didn't approve a budget increase until too late. And the Treasury wasn't equipped to just press a button and pay people. They had to actually physically print and send out checks in envelopes. And so they weren't equipped to do it. So they missed the deadline on a number of payments. And so they had to make people whole. And it was a messy process. And so that's a technical default. They're not saying that we're not going to pay you back. They missed the payment, So it's like you set up a payment for your power bill or your internet bill, and then your credit card gets tapped out, or your bank account, you forgot to put money in or transfer money in, and you overdraw. So it's the same kind of thing. You're going to pay it, but you oops. And so you're not supposed to have an oops at the Treasury level. It's frowned upon. And then the other way to default is a soft default, which is just continuously debasing your currency to the point where those dollars you're getting back after lending them for a period of time, whether it's 2 years, 5 years, 10 years, or 30 years, those dollars are worth significantly less than when you lent them. And that's a soft default. And we're just living it. And so the issue here is, I believe we're going to have a harder soft default where it stings more, where the inflation is higher. And I've written a lot about this. The CPI is not a great indicator of where prices are. Everybody knows damn well when you go to the grocery store, prices are up more than just a few percent than year over year. You used to be able to go to the grocery store and buy $100 worth of groceries. Now it's costing you nearly 200 or at least 150. And so that's an issue that's not going away. Those are the prices now. That's it. And so you have to figure out a way to make more money or to save your money in a way that it all protects it against an inflation. You actually have to figure out both things. So, and that's what the S&P, or that's what the S&P and really what Fitch is saying in my mind, is that, look, there's a higher probability that the US has a technical default. And because, look, the reality is we were bumped right up against the ceiling again. We have a super contentious political atmosphere here. And both parties use this debt limit as kind of a political football between the two of them, and try to force one party to do something stupid and make a mistake with their own constituents, be forced into a corner to do something that will lose them votes. It's just a game to them. It's not a game to us.
No.
It's serious. It's dead serious, and we're pissed off. We're sick of it. And so, is it meaningless? Like both Warren Buffett and Jamie Dimon say that the rating's meaningless. No, it's not meaningless. It's a downvote of confidence, and it's reality. The again, going back to the fortunate position we're in sitting in the United States, is that a weird thing happens where money will flood into treasuries when they see a higher risk of the overall market collapsing, because other markets will collapse around us before the treasury does, even if it's partially because of the treasury and the US dollar that other markets are struggling. It's a little bit, it's almost sadistic, really, but it's kind of a crazy dynamic, and that's where we're at, unfortunately.
It is crazy, and that's why I love the term political currency unit, and that's something that people have kind of grabbed onto, because it's what makes sense. You have currency that is backed by political energy, and so when there's conflict or tension there, as you said, both the blue and the red, the left and the right, whatever you want to call them, they leverage that to their advantage to get their political will through. And so it's almost like it's a system of energy, or it's like an engineering system, going back to engineering before. And as this political energy weakens, because we've drawn forward energy from the future to the present, we've expedited future productivity gains for today so we can spend them just to service the debt we have from the past. It's like it's slowly cannibalizing itself. And you're saying that we're lucky here in the United States that we have treasuries that are, compared to the rest of the world, uniquely in demand, let's say, because we have the strongest political currency, we have the strongest political might of any nation in the world. But my question to you is, what happens when that is no longer the case? As you point out here in this tweet, that it's an unfortunate reality that foreign demand for U.S. treasuries is waning. And so I would love to hear your elaboration on this chart, and this chart emphasizing that larger picture of what's happening here, of our American exceptionalism, of our unique ability to market these treasuries, perhaps is no longer as strong as it was in the early 21st or late 20th century. So could you break down this chart here? Because we're looking at over 20 years.
It's super simple. As our foreign buyers have less appetite, and we expand the sheer amount of debt that we need to issue, you're crowding out the marginal buyer. So you're crowding out some corporations, some international corporations, some individuals, some large individuals, family offices that already have enough treasuries they just can't buy anymore. And so you start crowding out those balance sheets. And what do? At some point, if you're a country that issues debt in its own currency, you print money and monetize the debt yourself, period. There's just that's your choice. You will print money and you will buy your own debt. And we're watching Japan do it as we speak. And Japan owns over 50% of their own debt. That's mind-boggling. So they're the largest holder of Japanese government bonds. And their debt to GDP has skyrocketed, right? So what they're doing is they're trying to induce inflation, but who's going to buy that debt when they're keeping it down below, like they're holding their 10-year treasury, they moved it up down under 1% yield. When you're looking around the world and you can get 4 to 5% yield here, you can get, near that in Europe. Why would you buy Japanese bonds that are yielding less than 1%? You wouldn't. So their own treasury, the Bank of Japan is having their own central bank is having to print yen and buy those bonds themselves. It's nuts. But then we're going to be, is it the same situation? No, Japan's a different demographic. It's a different financial system. They're a net exporter. We're a net importer. It's a completely different dynamic. But that's kind of the road that we're headed down. The U.S. will be the last standing currency, the dollar, in my opinion. Maybe the Swiss franc or something, but it's one of the very last. And so it will be one of the very last ones standing, and it will swallow a lot of others in the meantime on that road. The dollar will only gain in strength, you know. It I could see at some point the world gravitating to a system where you're exchanging in a currency like the dollar, and you're using the Bitcoin as a savings vehicle. That'll be your asset, and that could be some sort of reserve. Could it be a global reserve asset? Maybe. Could it be global reserve asset along with other assets like gold? Maybe. But this is a transitionary period that we're living through, and I think in my kid's lifetime we're going to see the treasury fall from the mantle of being the global reserve asset. That's just my belief. I don't know when it happens, but you know, these things, they take a very long time. People have been talking about the U.S. debt since the 70s. And, you know, ever since we got off the gold standard, you've seen the debt expand and expand, and that's just reality. And is it accelerating? Yes, it is. Are we in a debt spiral? Yes, we are. We have so much debt now that our numbers they just don't add up to the ability to be able to pay down that debt without super high structural inflation or some other type of event that creates the ability, like you're talking about, a war or something, to pay it down rapidly. So
yeah, it seems very probable. But one of the things that always concerns me is thinking about how in the last quarter of a millennia, so the last 225 years, 98% of the nations that exceeded that 130% debt to GDP eventually defaulted, and Japan is the one exception, and they don't look very good. And so that's my amazing thought experiment, that if 98% had that happen in hundreds of years, and it doesn't matter if the country was large or small, it seems pretty probable that we would maybe not entirely follow suit, but at least that could be the trajectory that we're on, you know. And so, and then especially going back to that earlier chart with the prediction from the Treasury, it's just amazing to me, because that prediction itself, the conservative prediction, the one from
that's an optimistic
yes,
view.
It's optimistic, and their prediction is it will be at 700% by the end of the 21st century. So it's like, I just look at it.
It's low, yeah.
I mean, do you go crazy? Because it's just like, it's so obvious. Like, okay,
no,
98% default at 130%. We're going to be at 700% by the end of the century, conservatively. Yeah. It's like, do you go? Does it drive you nuts?
It's absolutely unnerving, for sure. Yeah. And so that's why I don't hold long-term treasuries in any size in my portfolio, because of that. Interest rate volatility it can bite you, as we've seen the last few years. But look, Japan, this is an experiment that's gone a little bit wrong, and we're watching it unfold in real time. What happened last week is that Japan had, or just the end of the week prior, the Bank of Japan had come out and said, okay, we're still, for your listeners don't know what's going on, we'll get through it quickly because I do have another meeting here. But for what happened was, Japan has been trying to induce inflation in their economy. And so they've been holding interest rates down. It's called yield curve control. They've been buying their own 10-year treasury to hold it down at 25 basis points, right? They were doing that all last year. And at the end of last year, they raised that to 50 basis points, right? So at the beginning of this year, it was 50 basis points, but they're going to hold it there. So lower interest rates means cheaper borrowing, means it's easier money to loan out and borrow, and to create productivity, right? So as they're doing that, though, there's this great demand to sell those treasuries, because nobody wants to own these things at 0.5%. Not when the rest of the world is up in the 2, 3, 4, 5% land. You can get multiples for your money. So they're selling the Japanese government bonds, they're selling the yen, they're buying dollars, they're buying US treasuries. That's what's been going on. And so you're seeing the Japanese central bank, the Bank of Japan, they just recently, this last week, they said, we're going to double it. We're going to say that we're going to hold it at 1%. Now that's the absolute 50%, half a percent is a target, but the absolute top is 1%. So it kind of confused people. They're like, well, is it going to be held at 0.5% or where is it going? So you could see there's a lot of volatility in the yen and the treasuries and the 10-year bank, the 10-year JGB. But what it settled out into the 65 basis point range, where now you've got the Japanese experiment is coming to light, and they're realizing that it's going to be really, really difficult to come off this zero interest rate policy plan, because the treasuries that are flooding to the market they're substantial. So they immediately had to do an emergency bond buying program, like right after they had announced this, because it's difficult. You're getting people off of that they've been on this this trough, this free feeding trough for such a long time that they're addicted to it. They're addicted to the low rates, and it's difficult to get off. And so I don't know when it happens, but Japan, they can't keep doing this forever. It's everybody who says that to me, I'm like, okay, I hear you that it can go on for a while. It can. I don't know if they get to 500% debt to GDP. It can go on for a while, but something's going to give here. Something will give.
Yeah.
So
as we wrap up here, obviously both you and I are biased to Bitcoin, but I'm curious, since you mentioned the 0% to bonds, as a risk manager, and you said you're a low risk person, you have 0% bonds. That's
well, no, long bonds.
Long bonds. Okay,
Yeah,
that's what I was going to ask. So
yeah.
For you, I don't know if you say your percentages or whatever, but I'd be very curious to hear, how does that break down for you with the major asset classes? So obviously you have long duration, short duration, gold, real estate, stocks, and Bitcoin. What does that look like for you?
So I don't have enough time to go into it here.
Sure.
But for me, I have a higher than normal allocation to cash and short-term treasuries right now. Short-term treasuries are paying you a return right now. They're paying a yield that's pretty attractive for a minimal risk. Like the treasury's not going to default tomorrow, in my opinion. Is it possible? Sure, anything's possible, but it's a non-zero probability. Okay, so I feel comfortable there, and I've got a larger than normal allocation to hard monies like gold, silver, and Bitcoin, because I believe that we are going to see this period of a sell-off where I can opportunistically buy more of those things and buy risk assets when we do have a sell-off, and get ready to ride that next wave of money printing, because there's just no way around it. They're going to have to keep the markets liquid. And so what I'm concerned with, Luke, is that we have a credit event where we have a steep drop off in the markets because of some sort of unforeseen event that happens. We just watched Yellow trucking company. They're going to lay off 30,000 people because they're going bankrupt. They can't pay their debt. Well, that's what happens when you have interest rate risk, when you're exposed to interest rate risk. And so I don't know what happens, but if you have something that is more contagious, so instead of that just being a boon to the other long delivery drivers, then when you have something like more of a larger bank, or in the financial or in the insurance arena that collapses, that's going to be a much, much, much larger issue. And it could have huge implications to especially the treasury market. And if that happens, which I still believe there is a high enough risk of that I'm not comfortable being 100% invested right now, especially not 100% in risk assets. I do have some capital set aside to be, tactical about it. That's me. Again, so, and I'm a little bit older than a lot of your listeners, I'm sure. So some of them may have way more Bitcoin than I do, and some of them may hate some of the things that I talked about. That's okay. That's okay. If I was in my 20s, I would have a different mix of assets, period. That's what it is, So
makes sense. Our mutual friend Greg Foss has a target for Bitcoin of $2 million based on his formula and everything.
Right.
I'm wondering, do you have a target like that with X% risk to, treasuries or whatever, or
Yeah,
or do you even think in those terms?
yeah, no, it's simple. The way I think of it, I do have it. I do believe we have enormous growth in this protocol in particular ahead of us. And that means a ton of capital coming in. I do believe this ETF is going to be a large on-ramp for certain family offices and individuals that just have not been able to do this themselves. They don't feel comfortable buying Bitcoin and holding it in a signing device or a wallet. They don't have custody. They have custody issues because they're RIAs or whatever. It's going to be a huge on-ramp. But when you look at the landscape of investable assets in this world, and if you just do out the math of 3% on $700 trillion of investable assets in this world, that's $21 trillion. $21 trillion and 21 million coins. That's $1 million a coin. That's just so, and I do believe that we get there as I'm saying, as you stair step to that point where there's enough liquidity and where it can sustain the flow of capital without the volatility. Well, that will create the ability for these portfolio managers to hold this as a separate allocated class. When they do that, you could have a 1%, 2%, 3% position. It starts eating into that bond universe of long-term capital preservation. And so at that point, that's when it reaches $1 million. And I think that we're going to hit that at some point in this next, 7 or 8 years. Am I right? I mean, who knows? Bitcoin does what it wants to do, but I'm not even worried about it. It could be 20 years, but that's the path that we're currently on, in my opinion. That's it.
Yeah.
So,
well, hopefully we are directionally correct, not just for Bitcoin price, but also for helping people preserve their capital in the face of reckless political currency distortion, manipulation, and destruction. So, James, I know you got to go. Thank you for your time. Really appreciate it. I look forward to seeing you both digitally and in person next time. So, thank you very much.
Yeah, thank you for having me, Luke, and then look forward to the next time.